The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast. How's it going, everybody? Welcome back to Trajecta Talks. This is the podcast where we simplify complex financial topics into clear, actionable insights to level up your money game. I'm your host, Alex Savanovic, and I'm thrilled you're here for episode number 4. Whether you're commuting, grabbing a coffee, or just chilling, thanks so much for joining me. And if you're new, welcome. And if you're returning from our previous episodes, I'm super pumped that you're back. So, quick intro for the new listeners. I'm a finance grad from the Sauder School of Business at UBC. I started working at a hedge fund at 19 years old while still in school, and I'm still there years later, trading, evaluating startups for our private book, and structuring loans. That world taught me to manage risk with precision, and that's the perspective that I'm bringing to insurance today. A critical tool to safeguard your finances with discipline and strategy. Now, before we dive into the episode, let's do a quick market update for this week. Let me tell you guys, this past week, running from June 30th to July 3rd, was a quiet but interesting one. With Canada Day up north and Independence Day looming, it's been a shortened, quieter stretch on the street and a bit of a breather before the fireworks, if you will. But don't mistake quiet for uneventful. We still had plenty of action. On the geopolitical front, remember that chatter about Canada imposing tariffs on US tech? Well, that plot certainly thickened over the weekend. Canada's Prime Minister Mark Carney actually decided to drop his plans for a digital tax on US tech giants. This move was clearly designed to get Washington back to the negotiating table, and it seemed to have worked, with talks set to resume aimed at striking a deal by the July 21st deadline. So instead of a trade escalation, we saw a strategic de escalation there, a positive sign, even if our equity markets didn't show much concern about it to begin with. In the IPO market, the SPAC resurgence continued its quiet grind. We saw a few more blank checks hit the tape this week with Origin Investment Corp. The ticker on that is ORIQU. We had NMP acquisitions, that's NMPAU, and Indigo acquisitions at Early Bird Capital, that's INACU, all pricing their deals. Our desk was very active in some of these, participating in the renewed appetite for these vehicles. It just shows that despite the broader economic backdrop, there's still capital out there ready to back new public ventures. Now, let's talk about Washington and the reconciliation bill. That saga is edging closer to a deal, but it's not without its drama. The final price tag for the Senate version is looking far more expensive than initially envisioned, and it's dealing a bigger blow to the renewable energy sector. And of course, the legislative tango has reignited the fiery feud between Elon Musk and President Trump. So Musk has reiterated his threat to launch a third party and primary Republicans who voted for the bill. And Trump fired back, warning that all subsidies to Tesla and SpaceX could be terminated. There's still some serious grumbling from fiscal hawks and moderates in the House. So while it's likely something hits Trump's desk by July 4th, it's not a done deal. Now let's talk about some specific company headlines that made some serious waves. Robinhood definitely stole some of the spotlight this week, going all in on crypto. So on June 30th, at their To Catch a Token event in France, they unveiled a massive suite of new crypto-related products. This includes tokenized US stocks and ETFs for their EU customers, giving them 24-hour access with zero commissions, essentially turning their European app into an all-in-one investment platform powered by crypto. They're even planning their own layer 2 blockchain for this. And on top of that, they're launching crypto perpetual futures with up to 3x leverage in the EU. And here in the US, Crypto Stakes is rolling out for Ethereum and Solana. The market clearly loved it because Robinhood stock, ticker HOOD, surged nearly 10% on the news, hitting a record high. And speaking of big tech, Apple made some interesting headlines too, signaling a potential shift in their AI strategy. Reports emerged that Apple is reportedly in talks with OpenAI and Anthropic to integrate their advanced AI models into Siri. This is a monumental reversal, signaling that even the Cupertino giant is looking outside for help to supercharge its AI capabilities, acknowledging that its in house efforts have definitely faced some headwinds. This move aims to make Siri much smarter, and the markets reacted positively, with Apple shares seeing a bump on the news. On the economic data front, we got some mixed signals. China's manufacturing PMI came in a little ahead of expectations, and their NBS PMIs were a bit better than anticipated. And in Europe, June CPI was right in line, and inflation expectations are definitely cooling. Here in the US, the Fed's expectations remain steady for incremental cuts this year, with the next move largely anticipated for September 17th. Finally, the AI talent war is definitely heating up, creating fresh cost headwinds across the industry. We're seeing OpenAI boosting compensation, Meta offering massive compensation packages, and Microsoft's own AI chip development facing some delays. It's a full on battle for the best brains in AI, and it's certainly impacting the bottom line for these tech giants. Also, President Trump continues his intense criticism of the Fed, even calling Powell a stubborn mule, if you can believe it, and suggesting he'd love for him to resign. No love lost there, it seems. All right, folks, that's the market debrief for this shortened but still very spicy week. Fast, furious, and straight to the point. Now let's get on with this week's episode. So today's episode is Insurance 101, everything you need to know. Now, insurance might not get your heart racing, but it is your financial lifeline, protecting you from car wrecks, medical emergencies, home disasters, or much worse. We'll unpack the basics, decode the jargon, and dive deep into auto, home, health, and life insurance, plus some common pitfalls to dodge. And by the end of it, you'll know how to choose coverage that saves you money and stress so you can focus on building your future. Now, let's dive right in. Insurance is your shield against life's unpredictability. So, accidents, illnesses, theft, or natural disasters, it's a contract. You pay a premium, and the insurer covers costs if things go south up to your policy's limits. In 2025, with costs climbing, insurance is absolutely a non negotiable. Without it, a single car accident or hospital stay could wipe out your savings or bury you in debt. And for students, young professionals, or anyone starting out, insurance is about peace of mind. Ensuring one bad day doesn't derail your financial goals. It's not about expecting disaster, it's about being ready to recover when the unexpected strikes. So, a little bit about how insurance works. It spreads risk across millions, keeping costs manageable. Without insurance, those costs would fall on individuals. So, by paying 100 to 300 bucks a month, you avoid the $10,000, $100,000 hits when something happens, making insurance a cornerstone of financial literacy. And it's a topic that I'm passionate about through my work with Trajecta University. Let's lay the groundwork. Insurance transfers risk from you to an insurer. You pay a small, regular amount to avoid catastrophic losses, like a $50,000 car repair bill or maybe 500,000 to rebuild a home. It's like hedging in finance. You sacrifice a little now for protection later. So here's the essential lingo to navigate policies confidently. So first up is your premium. This is your payment to maintain coverage, typically monthly or annually. So for example, something like $120 a month for auto insurance or $25 a month for renter's insurance. Premiums vary by perceived risk. So young drivers will pay more due to higher crash rates. And if your home is in a flood zone, your premiums will be higher than someone who lives in a safer geographical location. You sort of get the point there. Next up is deductible. This is the amount that you pay out of pocket before your insurance kicks in. So a $1,000 deductible means you cover the first $1,000 of a claim and the insurer pays the rest up to your policy's limit. So higher deductibles means lower premiums, but it requires you to have savings so you can pay that deductible. So this is often the first place everyone goes to lower their monthly payments, and it's the most fungible part of your policy over time. Next is coverage limit, the maximum payout per incident. So a $100,000 liability limit caps payments at 100 grand, even if the damages hit 200 grand. You would owe the rest. That means you would owe 100 grand after your insurance covers that first 100. Next up is claim. This is your request for payment after an event occurs, like filing for home repairs after a fire. Claims require proof and can raise premiums if they happen frequently. Next up is policy. This is the contract detailing your coverage. It talks about exclusions like floods and standard home policies and goes over your terms. Next up is exclusions. These are non covered events or items like normal wear and tear, intentional damage, or high risk activities like skydiving when it comes to life insurance. Next up is rider slash endorsement. These are add ons for specific risks like 10 grand for jewelry coverage or flood protection. Mastering these terms lets you compare policies like a pro. A key strategy: balance premiums, deductibles, and limits. So a $60 a month auto policy with a 5 grand deductible and 25 grand limit looks cheap, but it leaves you exposed in a 50 grand crash. Aim for a higher month policy with a slightly smaller deductible and maybe over 100,000 in limits if your budget and savings allow. Also, always review exclusions. This is so important. Missing flood coverage in a high risk area could cost you thousands, if not hundreds of thousands. For claims, document everything. That's damage photos, police reports, receipts, anything and everything to avoid delays or denials. Auto insurance is mandatory for drivers covering accidents, theft, or damage. In Canada, liability coverage is required. I think it's 200,000 in Ontario, 50 grand in BC, and US states mandate 25 to 50 grand. It varies liability coverage. So here's a detailed breakdown with strategies to optimize. Liability coverage covers damage or injuries that you cause if you're at fault. A rear end collision costing 40 grand for repairs, medical bills, legal fees is covered up to your limit stated in the policy. So low minimums risk personal liability for excess costs. Get a 100 grand to 500 grand liability. It adds 100 to $200 a year, but protects your assets. A crucial point here is that your insurance liability needs to match your net worth. If you have a house in your name that was gifted to you and someone slips at your apartment and you have a $300,000 liability, you could have a major problem. Your coverage needs to change with your balance sheet. You might need excess liability, which can be expensive but protects a defined dollar amount that you need. This does not only apply to auto insurance, but anything where liability is at play. Collision coverage pays for your car's repairs after an accident, regardless of fault. Hitting a car, a tree, or guardrail. Repair costs can be expensive and can vary extensively. Collision coverage is crucial for cars worth over 5 grand. If your 2010 Honda is worth 2,500 bucks, maybe you consider skipping it to save some money every year if you feel like this isn't worth it for you. Comprehensive coverage covers non collision losses: theft, vandalism, fire, floods, or wildlife collisions. Comprehensive replaces an entire stolen car as long as you pay your deductible when making the claim. Rural drivers with older cars might skip it if theft rates are low, so make sure to check local statistics on these sorts of things. And reminder, in Canada, a lot of auto insurance is mandatory, so definitely check with ICBC or your local DMV to see what is required. So here are a couple insurance strategies. Want to make sure we're shopping quotes from different insurers. This is a huge one. Prices are not standard across the board, and there are many incentives out there being offered. Take your time and shop around. Claim discounts such as safe driver discounts on auto insurance. Students sometimes get discounts, and anti-theft devices can lower premiums at times on auto and home insurance too. So don't be afraid to ask. Think about maybe raising your deductibles from 500 to 1500 if you have 3 grand saved, and that can cut your premiums by a substantial amount also. But remember, only do this if you can afford the deductible. Don't raise it to an amount that you can't afford or don't have saved up. We also want to be reviewing annually if you have new cars and move to urban areas or have many driving infractions or tickets, your needs might change. So check your driving record frequently too. Any errors can inflate your premium, so make sure you're staying on top of that. Next up, let's talk about home insurance. So, home insurance protects your home or apartment contents from fires, theft, storms, or vandalism. Homeowners need it and it is mandatory if you have a mortgage on your home. Here are some of the specifics on home insurance. So, the term dwelling coverage, this covers your home's structure like roof, walls, plumbing, HVAC. So, a fire or tornado could cost millions to rebuild. So, ensure that your coverage matches 2025 rebuild costs, not your purchase price. $1 million home might need 1.25 million in coverage due to rising labor and materials if you built the home 20 years ago, for example. If you're underinsured, you'll pay the gap, and that can be a pricey hole to fill. Next is personal property coverage. This protects things inside your house like furniture, electronics, clothes, and appliances. Next is liability coverage. This covers injuries or damage on your property. If a guest breaks an ankle on your deck, it can pay for medical bills or lawsuits. And this can also sometimes cover off property incidents too, like when your dog bites a neighbor, for example. So, what are a couple strategies for your home insurance? Always inventory your belongings. Do a video walkthrough, photos, take a bunch of photos, keep receipts. This will make your claims go faster and they'll be fairer. Update your coverage after renovations or big purchases, like expensive TVs, for example. Next, claim discounts. Things like security systems, smoke detectors, these things can shave your monthly premiums down also. Add endorsements for excluded risks, things like floods, earthquakes, fires in high risk geographical areas. And review your policies annually. Always be assessing what your needs are and make sure your insurance covers you. Things can change a lot year to year, and you don't want to be overpaying for coverage that you don't need, or underpaying and exposing yourself in the event of an accident. Next, let's talk about health insurance. It's critical, especially for students and young adults navigating uneven systems. So in Canada, there's public plans like MSP that cover doctor visits in hospitals, but not prescriptions, dental, vision, or physiotherapy. And these things cost a lot every year if you pay out of pocket. So, what are the coverage types? First one that we mentioned a little bit in Canada, there's a pretty robust public system, covers the essentials like surgeries, emergency room visits, but it excludes drugs and vision care, for example. So, up until this year, it also excluded dental, but the government now offers coverage for qualifying individuals. This is definitely something to check out as it can be a huge savings every year on keeping that smile healthy and clean. University plans cover prescriptions, dental, vision. The one that my friends used in UBC wasn't overly expensive and covered, I want to say, something like 70 to 80% of the cost of dental visits. Employer plans and marketplace plans can vary significantly, so we won't do a huge dive, a whole lot into what every tier or what every workplace has to offer. It just wouldn't be a great use of our time on this podcast. So now that we've covered some basics about some insurance that you'll probably see over the course of your life, let's dive into a bit of a trickier one, and that is life insurance. Life insurance ensures that loved ones aren't financially burdened if you die. So this is covering mortgages, education, or living expenses. It is absolutely vital, and when it comes to life insurance, whole life is the only option that truly matters. And frankly, term life insurance is a waste. Whole life insurance, what is that? Whole life insurance covers you for your entire lifetime, building a cash value that grows steadily over time. This cash value acts like a savings component, accumulating at typically 3 to 6% growth. You can borrow against it too, providing a liquid asset for emergencies or opportunities. Premiums for whole life policies are generally higher, ranging from anywhere between 150 to 450 bucks a month for 500,000 in coverage. But this higher cost is an investment in lifelong protection and a growing asset. Here's the critical wisdom to understand. The age at which you purchase life insurance is the single most important determinant of its cost, dictated by actuarial science. You must take advantage of your youth to buy whole life. So pay more now, let that cash value build and grow into the policy. Even if your financial situation changes down the line and the policy doesn't work out as initially planned, you can always move on, taking whatever cash value is left minus the cost to insure. The reality is, anyone looking for life insurance can afford whole life if they prioritize it and start early enough. So, why term life insurance is not the answer? Well, while it's often marketed as a cheaper alternative, term life insurance only covers a specific period, like 10, 20, or 30 years. If you pass away during that term, your beneficiaries get a payout. But if you outlive the term, which most people do, the policy simply expires, you get nothing back, and it's akin to renting an apartment for years and having no equity to show for it. You pay premiums for temporary coverage, and when that temporary coverage ends, you're left without protection, often at an age where new whole life policies become prohibitively expensive due to increased health risks. The idea of renewing a term policy is often a shock, as premiums can jump anywhere between 60 to 120% or more, making it unsustainable for most people. So let's talk about choosing whole life coverage. When determining how much whole life coverage you need, aim for 8 to 12 times your income. So 400 to 600,000 for a $50,000 a year salary as a starting point. Then you want to add any significant debts. For example, if you've got 100 grand in student loans. And then you want to think about potential education costs for future children. So roughly 50,000 a child. And you also want to take into consideration anticipated funeral expenses. Compare quotes from reputable insurers like Manulife, State Farm, Prudential. Policies can still vary by 25 to 45%. The most crucial advice: buy young. Premiums for whole life policies rise about 10% per year of age and any developing health issues, things like hypertension, for example. That can add another 20 to 60% to your costs. Starting early locks in a lower rate for life. While employer group plans might offer some basic coverage, these are rarely sufficient on their own and typically don't offer the cash value growth of a dedicated whole life policy. So, some pitfalls to avoid with life insurance: the biggest pitfall is simply not getting whole life insurance early or being lured into the temporary solution of term life. A $150,000 whole life policy might seem sufficient now, but it won't cover a $400,000 mortgage and provide for your kids' futures if you're not also building wealth within the policy. So read the exclusions carefully too. Things like suicide within the first 2 years, their high risk hobbies like rock climbing, skydiving, or undisclosed health issues can void your payouts. Review your whole life policy every 2 to 3 years. Major life events like marriage or having children or buying a $1 million home will change your needs and might warrant increasing your coverage. I want to take a quick pause here and say that life and health insurance are very complicated businesses. And what we covered here is a very high level overview. We will release an episode in the future solely on life insurance and how to navigate it in much, much more detail. So, for the purpose of today's discussion on insurance in general, we're going to leave it at that and move on to other topics. So, let's talk about how to avoid costly errors that leave you exposed or overpaying when it comes to insurance. Let's talk about underinsuring first. Low coverage risks huge losses. A $60,000 policy will not replace 150 grand in belongings, obviously. So calculate rebuild costs on a home, like I said before. Take into consideration your car's value or your income needs when it comes to your life insurance. Number two, overinsuring in the wrong places. While we advocate for robust whole life coverage generally, unneeded coverage in other areas just wastes money. A $4,000 car doesn't always need comprehensive, unless obviously where you live makes it an obligation. So ensure that you're matching policies to assets and life stage outside of your essential whole life foundation. However, when it comes to life insurance, it's rarely about overinsuring, but rather about having the right kind of permanent protection. Don't ignore deductibles. A $3,500 deductible lowers your premiums, but it really hurts if you lack those funds. Ensure that your emergency fund always covers your deductibles. Next up, skipping the fine print on exclusions or limits can void claims. Understand how much you're covered for. Ask, does auto insurance cover ride sharing? Does health insurance include physio? Read your policies in detail or grill your agent. That's their job. They need to be able to answer these questions for you. Understand what your policies are covering. Let's talk about how do we pick policies that protect us without draining us financially. First, you want to make sure you're mapping your risks and list your vulnerabilities. Car accidents, health costs, home risks, rank by likelihood and the impact. So auto and healthcare are sort of at the top of most 20 or 30-year olds lists alongside the foundational importance of whole life insurance for long-term security. Factor in your lifestyle too. Urban renters face higher theft, rural drivers, there might be wildlife collisions. Think about all of these things when picking out a policy for any type of insurance. Number two, check your obligations. I mentioned this earlier a little bit. So, auto liability is mandatory. Mortgages require home insurance. Car loans need collision and comprehensive. So, skipping legal minimums puts you at risk of severe fines, license suspension, or vehicle seizure. So, confirm with your lenders always what your insurance obligations are before you take on a loan. And like I've said a few times in this episode, it's a smart thing to review annually. Life changes, $35,000 car, marriage, 15 grand in furniture. Your needs will constantly shift over the course of your life. A move to a flood prone area, you need flood coverage. It's that simple. So schedule a January review, let's say, every year to adjust limits if needed, add endorsements or drop unneeded coverage. Also, take the time to review your whole life policy and understand how its cash value is growing and if it continues to meet your evolving needs. So that's a high level wrap on all things insurance. Like I said, there was a lot here and some confusing terms. So feel free to DM us any questions that you may have. Like I've said in the past, this podcast thrives on your input, and last week's questions were great. So please keep them coming. DM us on Instagram, Facebook, or LinkedIn, or hit our website. The link's in the show notes for all of those things. And as I've said in the past, this episode is brought to you by Trajecta University. That's my passion project to teach financial literacy and real world skills. We offer courses for students, there's career coaching, seminars on budgeting, taxes, investing, and one on one sessions with finance pros. Don't miss our stock picking competition either. It's absolutely never too late to submit your stock picks. We will go through them at the end of every episode. See the show notes for more information on that. So, folks, that's episode 4 in the books. We covered insurance basics. That's auto, home, health, and how whole life is the definitive choice for life insurance, along with some common mistakes and how to choose policies that protect you without overpaying. The takeaway: insurance is your financial armor. Get it right, and you'll save money and stress when life throws its inevitable punches. Remember, when it comes to life insurance, think long term and permanent with whole life. Anything else is a temporary measure that won't serve your enduring needs. Now, if this episode added value, subscribe on Spotify. Catch full episodes on YouTube. And if you want Trajecta's courses or more information on the stock picking competition, visit our site. All the links for the show and Trajecta University are in the show notes below. Please remember to share this episode with a friend who needs it. That's how we spread the edge. So thanks so much for being here, folks. Like I said before, I'm Alex Savanovic. This is Trajecta Talks. See you next week and have a very, very happy Friday. Take care, guys.